Global markets are shaking. The world's most stable financial giant just broke. What you're about to hear is not a warning. It's the beginning of a crisis unfolding in real time. And almost nobody is prepared for what comes next. Global markets over the last few weeks have felt different. Not chaotic, not panicked, but uneasy, like the calm before a storm. A quiet tremor building under the surface. A shift that started subtle, then grew louder. Bond markets turned jittery. Yields spiked violently. Analysts began using words they normally avoid. Meltdown, contagion, liquidity, crisis, systemic danger. And today that faint worry became a global alarm. Because Japan, yes, Japan, the world's most stable financial system, the country known for discipline and calm, just triggered a shockwave that's now spreading across every major bond market on Earth. This isn't speculation. This isn't fear-mongering. This is happening right now, in real time. For over 30 years, Japan's bond market carried a reputation of being unbreakable. The Bank of Japan kept interest rates near zero, sometimes even negative, letting the government borrow endlessly. Japan's debt-to-GDP ratio soared past 230%, the highest in the developed world, and yet nothing ever broke. Investors trusted Japan so much that the impossible became normal, until now. Over the last few days, Japanese government bond yields, especially the crucial 10-year, spiked to their highest levels since 2007. A pressure cooker finally exploded. But the shock wasn't just the movement. It was the source. The sell-off wasn't driven by foreign traders or hedge funds. It came from inside Japan. Domestic banks, insurers, pension funds, the same institutions that always absorbed Japan's massive debt, suddenly backed away. And the world asked the one question no one ever expected. If Japan can't support its own debt anymore, will? The trigger was political. Japan's new Prime Minister, Saitake, announced a massive fiscal expansion. More spending, more borrowing, more intervention. In a normal environment, this might not have caused panic. But right now, it's the worst timing possible. Japan is trying to issue more bonds at the exact moment demand for those bonds is collapsing. Recent auctions showed historically weak interest. And when supply surges while demand collapses, yields explode higher. In a country with more than 1,300 trillion yuan in debt, rising yields can turn lethal very quickly. And just when Japan needed its central bank the most, the Bank of Japan stepped back. Inflation, something Japan barely dealt with for 40 years, has returned. Prices are rising. The BOJ can no longer print unlimited money and buy unlimited bonds. They've been forced to unwind their ultra-loose policy. They're cutting back on bond purchases. They're letting yields rise. And for the first time in decades, Japan's government is standing in front of the bond market without guaranteed support. The market reacted instantly and violently. But what happens next is the real story. Japan is not just a big economy. Japanese institutions control more than $12 trillion in global assets, U.S. Treasuries, European bonds, corporate debt, emerging market debt. If Japanese yields rise high enough, these institutions will be forced to pull money back home to stabilize their domestic portfolios, not because they want to, because they'll have no choice. And the moment Japanese yields spiked, global markets felt it instantly. U.S. Treasuries sold off. European bonds dropped. Emerging markets wobbled. Volatility jumped within minutes. That's how interconnected the system is. Japan moves, and the world trembles. Experts are calling this a $12 trillion shock because that's how much global capital Japan indirectly controls. If even a small portion of that money flows back to Japan, global liquidity could evaporate almost overnight. Credit markets could freeze. Borrowing costs could surge. Currencies could whipsaw. Stock markets could slide. Real estate could weaken. Companies could struggle to refinance their debt. All because the one market that was never supposed to break just cracked, and the timing couldn't be worse. The U.S. is drowning in $34 trillion of debt. China's shadow banking system is collapsing from within. Europe is facing recession, political instability, and fiscal strain. Emerging markets are stretched thin. Corporate debt globally is reaching dangerous levels. Japan was the quiet pillar holding everything together. The stabilizer no one talked about, but everyone relied on. When that pillar shakes, the entire tower becomes unstable. Markets reacted within hours because investors understood one brutal truth. When Japan's yields move sharply, the whole world moves. For decades, Japanese insurers, pension funds, and banks quietly supported global markets. They bought foreign debt when others panicked. They kept yields low across the world. They stabilized markets without anyone noticing. But now, Japan is the one panicking. Within 48 hours of the yield spike, Japanese insurers began cutting foreign bond purchases, reducing duration, preparing for domestic losses, and shifting reserves back into Japanese government bonds. This isn't cautious behavior. This is crisis behavior. And when insurers pull back, the gap they leave behind is massive, a global vacuum worth trillions. The United States felt it immediately. Japan is the single largest foreign holder of U.S. Treasuries. When Japan slows its buying or prepares to sell even a small percentage, U.S. borrowing costs rise fast. Higher yields mean higher mortgages, higher corporate borrowing costs, higher government interest payments, higher credit card rates, lower consumer spending, and pressure on stock markets. The U.S. Treasury market is the backbone of global finance, and even a minor shift from Japan can destabilize it. Europe reacted next. Already vulnerable due to recession risks, political turmoil, and debt issues in Italy, France, and Spain, Europe saw bond yields jump across the board. Italy's borrowing costs surged. France saw heavy outflows. Even German bond yields spiked. Europe is extremely sensitive to global financial shocks, and Japan delivered one of the biggest in years. Japan's meltdown is being driven by three forces colliding at the same time. Inflation returning after decades. A rapidly aging population, shrinking domestic demand, and increasing pension liabilities. An aggressive fiscal policy from new leadership. These forces combine to create a perfect storm. But there's still one more layer, the yen carry trade. For over 2 decades, traders borrowed in Japan at near zero rates and invested in higher yield markets worldwide. This trade pumped money into U.S. stocks, Indian markets, emerging markets, crypto, corporate debt, and tech giants. But when Japanese rates rise, the carry trade unwinds violently. Traders must buy yen, sell foreign assets, reduce leverage, unwind risk positions. That creates global selling pressure, and that's exactly what the world saw. Within days, the World Bank and IMF issued warnings about rising global debt stress and synchronized financial risks. Japan didn't create the global debt problem, but Japan just exposed it. Because if the world's most stable bond market can shake, then any country's debt can shake. The message is simple. No nation is immune. Japan was the quiet backbone of global debt, the stabilizer no one questioned. But the moment Japanese yields spiked, the world realized a brutal truth. If Japan can lose control of its debt, then no one is safe. The US is drowning in record deficits. Europe is cracking under political and fiscal pressure. China's financial system is weakening. Emerging markets are one shock away from default. Japan didn't start the fire, but it lit the fuse. The next few months will show how far this fire spreads. Because a $12 trillion repositioning doesn't happen quietly. It doesn't happen slowly. It definitely doesn't happen without consequences. If what we just saw was only the warning shot, then what does the real crisis look like? And more importantly, is the world prepared for what comes next? If you want breakdowns like this that cut through the noise and show you what's really happening behind the markets, make sure you subscribe to Finance Glow.